K Gupta, Managing Director and Chief Executive Officer of Essar Oil, joins us now. Mr. Gupta, good morning. Thank you for joining us. Let's first talk about your ECB plans. You plan to raise about $2 billion. Now, $2 billion is about 11,000 crore. What will you do with 11,000 crores?
Because as of now, the Reserve Bank of India, as you are aware, they have brought this policy that the companies who have export earning, they are allowed to borrow ECB to the extent of their 75% of best export in last 3 years, and we are eligible to under that $2.27 billion. And the whole purpose of this is to refinance the rupee loans, because as you are aware that Essar Oil, basically all the revenue streams are in dollars, and this is a mismatch in our balance sheet that we have rupee borrowing. So we are trying to replace the rupee borrowings with the ECBs.
You know, most of the Indian corporates which have opted for dollar borrowing in last 4 or 5 years, they are suffering because rupee has plunged against the dollar. So what gives you the conviction that a rupee loan or a dollar loan is better than a rupee loan?
Yeah, Nico, as I mentioned to you just now, as far as Essar Oil is concerned, our total sales are in dollars, our total purchases are in dollars, our margins are also therefore are in dollars. So as far as Essar Oil is concerned, our total revenue streams are in dollars, and in balance sheet when we have rupee borrowings, in fact that is a risk in our balance sheet, because if rupee appreciates, then our earnings will reduce in terms of rupee, and we will lose. So we are completely neutral to any appreciation and depreciation in rupee if we convert everything into dollars, because then we are 100% dollar driven company.
Mr. Gupta, morning then. We understand that you've been reducing crude sourcing from Iran. Which are the alternative markets that you've been now sourcing crude from?
As you are aware, we have completed our expansion and optimization projects in March and June respectively this year. And with this, our complexity has gone up from 6.1 to 11.8. What that means is that we are now able to process a very low API. That means our average API of crudes processed, which was about 32, 33, has now come to 26, 27. So predominantly, we are now going for more of heavy and ultra heavy crudes. And our basket therefore is shifting more towards the Latin American countries rather than Middle East.
You've been increasing Nelson complexity of refinery as well. How will that help you to refine dirty crude?
Basically, the increase in complexity means that a refinery is able to process more of heavy and ultra heavy crude. And in spite of processing heavy and ultra heavy crudes, which are comparatively cheaper as compared to the light and sweet crude, we are able to maintain the throughput slate, which is more towards the light and middle distillates, which give you better revenue. So just to tell you that in second quarter of this year, we processed more than 80% of heavy and ultra heavy crudes, and out of which 64% were crude which were very ultra heavy. And despite that, our product slate of light and middle distillates, which is mainly petrol, diesel, ATF, kerosene and LPG, naphtha, has gone up from 72% to 82%. So this therefore improves the profitability of the refinery, because you are able to process the more of ultra heavy crudes which are cheaper and still produce the higher end of products which are Euro 3, Euro 4 and light and middle distillates.
So Gupta, Mr. Gupta, I mean your GRMs then, they've been improving. Tell us, how do you see them panning out in the coming quarters? Would you maintain, or would you see a higher profitability going forward?
Yeah, as I just mentioned to you that once we have increased our complexity, we are able to process more of ultra heavy crudes which are cheaper, and we are still able to produce higher end of the products. And therefore, the second quarter where we had GRM of 7.86 is just the beginning of what is going to come. And in fact, in the month of September, when our all things were completely stabilized, we had a GRM of 10 plus. So going forward, my take is that our complexity should get truly reflected in our results, and we can look to the future with a very good workings from Essar Oil.
So in terms of a crude benchmark, what are you benchmark against?
As far as crude is concerned,
What's your crude benchmark? I mean,
so
are you
we are
benchmark against NYMEX? Are you benchmark against Brent? Are you benchmark against some other category of crude?
yeah, basically, as far as our products are concerned, they are benchmarked against AG normally. So that means our normal benchmark for crude oil is Dubai, and therefore, when we buy our crudes, we try to convert all those into Dubai.
Since Essar Oil has gone through a massive expansion in last 2 to 2.5 years, share some more details with us if you can, that how much of your existing expansion is still due, and for 2013, what will be your total refining capacity, operational refining capacity, not proposed refining capacity?
Yeah. We have completed our expansion in March and optimization in June. Now with that, our capacity today is 20 million tons a year. Our second quarter throughput has been 5.07 million tons. Month on month, we have produced 1.7 July and August, and 1.66 in September, which was 30 days. So our capacity now is fully operational, which is 20 million tons a year. And our complexity, as I just mentioned to you, also fully in place, because we have used more than 80% of heavy and ultra heavy crudes and still produce more than 82% of light and middle distillates.
I'm going to ask you.
Going forward, we will.
I'm going to ask you a very basic question,
forward,
Mr. Gupta, and this question may sound slightly repetitive to you. Yeah, you know, I know a lot of retail viewers were watching the show. They often tend to believe that if crude goes up, refining companies will make more money. If crude comes down, refining companies will start losing money. Is that the correct way of looking at your business?
No, because you are absolutely right. That is not the correct way of looking at the business. What you need to see is the capacity of refinery to process the tough and heavy crudes, because those are the crudes which are cheaper. When I say cheaper, it doesn't mean that the crude prices have come up, so crude has become cheaper. The value of a crude for a refinery depends on its complexity, the way it can process the same crude. Like a less complex refinery can process the same crude and still not make the products which a highly complex refinery can make. So basically, once you increase the complexity, you are able to process the crude which are tough, which cannot be processed normally by less complex refineries, and therefore the value to those crudes for a complex refinery is better. And I agree with you completely that crude prices going up and going down does not have much relevance to a refinery, because we are more concerned with the margins and not the basic crude price.
Mr. Gupta, what about your balance sheet picture right now? What's the kind of debt and cash levels that you have on your books?
So, after we have completed our expansion and optimization project, we have a debt of about $3 billion on our balance sheet. And as far as the cash flows are concerned, we have always given a sort of guidance that we are going to have almost $7 to $8 better than IEA margins. So if you see going forward, we expect that our EBITDA numbers should be in the range of about $1 billion. So it is 3 EBITDA, which is quite normal.
You know, since you have a debt, so I'm more curious to get a guidance on the PBT number.
Sorry, Nikunj, I am not able to hear
My
you.
question is, since you have a debt, you've given an EBITDA guidance, you've shared an EBITDA guidance, thank you for that. But I'm also curious to understand the PBT guidance, profit before tax guidance. Since you have a debt, there could be a big difference in your EBITDA growth, and there could be a big difference in your profit before tax growth or PBT growth.
Yeah, presently we have a debt of about $3 billion, and therefore the EBITDA margins of what I suggested just now, they don't convert into profit after tax in the same proportion. And going forward, once we have these cash generations coming in, I am sure the generations are going to be utilized to reduce the debt, and going forward the PAT number or PBT numbers are going to look much better.
Mr. Gupta, really good having you on the show. Appreciate you taking the time out and chatting with us candidly about what's the picture going forward for Essar Oil. Let's bring up the stock price for you and show you how it's panning out. Marginally soft, as is the case with the rest of the market. The futures now at 56.37. The premium has gone down to about 9 points. And let's bring up the Nifty spot as well. Well, the Bank Nifty again is down about 27 points. We've